Good morning, everybody. Mike Vacchi, Princetontrader.com, here with your Friday morning pre-market webcast. Okay, couple things. You've got the daily chart. We talked about this multi-day rally about 3 or 4 days ago, and you had your matching lows here. The 200-day simple moving average and exponential average held up. So the bulls at that point retained long-term control if they could follow through. You're seeing the follow through now. It's going on 5 days. And now we're reaching towards the daily midband, which we've also talked about this week. The daily midband for me determines whether we are ultimately a buy dips market or a sell rallies market. So how the daily midband reacts to price today is going to determine things. The fact that it stopped there last night doesn't mean a whole heck of a lot to me, and here's why. The last 2 days in a row, I put these big green V's here. I should have made the font like much bigger to signify their importance. You've had 2 V bottoms, okay? Basically just flaming dip buys. One on Wednesday and one yesterday morning. And as I watch the bears roll this thing back from 46 right now into 33, I tend to, think and wonder, and along with a lot of other people, whether we're just going to go ahead and make today's dip. And until the bears can prove that whatever we're doing here on the downside is not today's dip, the market is going to stay into those same dip buying habits, and they're going to buy it, and they're going to send it higher. And then the issue is going to become, how does it react when it gets to the daily midband? If the bears want to make some noise today, they've really got to persist, and they've got to hold these moves down. The one on Wednesday was news driven. The one yesterday was, was kind of choppy, and then we ended up catching the short. I didn't buy the low because that's not my style, but we spent the rest of the day getting into a variety of longs, just solid, 10 handle runners, 10 handle runners, 11 handle runner, 11 handle runner. And, when they dipped it back down into the 23 area into the close, the reaction of the AD and the fact that at that point we were trend up, that was just another buy. And the biggest bummer of last night was that it stopped us out on a 23 quarter long at 33 quarter because I wanted to lock in some profit. Then it runs up and does 46. Now that's kind of a first world problem, but just to let you guys know that aren't in the room, that's kind of, we spent yesterday long. Once it finally figured out that low was not going to hold and started getting up over the top of some of the things that we track, like volume weighted average price, proprietary moving averages, the other stuff that we look at during the course of the day, there was really no looking back. So that's 2 days in a row. Anybody that's followed me for any period of time knows that my feeling about the S&P Futures is that they tend to get habitual. You want to talk about buy the dip. I mean, it's kind of habitual. It's Pavlov's dog. They ring the bell, you come and eat, and we head higher, and then you go home. The last 2 days we've gotten into these dips. So what the bears are going to have to overcome in order to avoid that today is they're going to have to create lower highs and lower lows after they dip this market. And I would argue that, 46 back to 34, 33, we're retesting the overnight low. Overnight low came in 32.5. We just did 32.5. So the first thing they're going to have to avoid is matching lows at 32.5. If they can overcome that and turn, say, 32.5 into resistance, well, that's the way you convert the hourly midband here. That's the way you get down in and towards the daily pivot. And if you convert the daily pivot, then people will take notice that maybe the bears are serious today. That said, if you don't, then the dip buyers come in a little bit, and we end up heading higher. So on an intermediate term basis, can the bears still win the day? Sure, absolutely. All they have to do is win this battle up here. That's all they have to do. There's nothing wrong with a big down move in a market that goes up to test the daily midband, that goes back down to re-engage the daily lower band. That's called a futures contract that wants to be ultimately sell rallies. We see it in other instruments all the time. We just haven't seen it in this particular instrument, in 9 years. So, we tend to be pretty skeptical when it gets back up towards these areas. We've had these tests before. The bulls have always won them. So can the bears win it this time? Sure, but they're going to actually, they're going to have to put the work in. They're going to have to execute. And the flip side of that is if the bears lose the battle here at the green line again, then the dip buying will increase, especially if there's earnings to support it, and you're going to head right back on up to 28.78. I said it 5-6 months ago, and I said it again right around Thanksgiving and into the new year. I felt that we would go back to the 200-day during the course of 2018. I really didn't think it would be in the first month of the year, but you get there when you get there. Way back when we had yet to touch 2,000, I said the best way to do it would be to go back and touch the 200-day exponential moving average, establish it as support, everybody reloads, and you go up and do it, which is what happened. If a double bottom, if we were going to do 3,000, and I'm not saying that we are, and I hate people to go on TV and write blogs and all this other stuff, and I tell you this because I don't want people fighting price if it gets out of hand. But if you were going to do something like that, making matching lows down in the 25-20s and establishing two pairs of 200-day exponential moving averages as support, and then ripping through the daily mid-band and buying dips every day, well, that's the recipe to fuel that kind of a move. We'll talk about this more in the days and weeks to come if it gets over the top of daily mid-band, but I don't want people sitting here thinking that 28.78.5 is a wall. I'm not sure it is, and we'll talk about that as we get in. But look, my focus is on the intraday stuff, on the 5 handles in front of me and the next 5 and 10 handles in front of me. And in that regard, just by example, 22 yesterday, 48 the day before, 12, that day kind of sucked, and 45. So the volatility is there. It's a very active market. It's a treacherous market. If it's a market that you're confused in trading or you need some help, come in and meet us. It's a great group of people. We would love to meet you. Have a fantastic long weekend. I will be back Tuesday morning with another webcast. Enjoy it, trade them well, and I'll talk to you then. Follow us over on Twitter, Instagram, and Snapchat at Princetontrader. Check us out on Facebook and join us for a free trial at www.princetontrader.com. Trade them well.